you are not afraid of being the first movers in a new location.
Why should this city behave any differently to all the other UK cities?
You've got the analytics, you've got the data, but ultimately you've got to make a decision based on what everyone feels is the right outcome.
You can have the worst processes in the world, and if you've got good people, you can still make things work.
As the forward funding market come back,
that trend will come back.
What's going to happen with the OPEX?
I think technology will play a part in that. The world moves much quicker. You might only have a 6-month window before your next economic impact hits.
Welcome everyone back to our second episode of Reinventing Real Estate. The whole point of this podcast is to grant you access to the trailblazers in the industry and find out insights on where they think real estate is going, what they're working on at the moment, and their market perspective. So we're going to jump right in, and we're really honoured to have Alex Pease with us and also George Dyer. So I will hand over to you guys to give a better explanation of what it is that you both impressively do on a day-to-day basis.
Morning, thank you. My role is really looking after all of our acquisition, planning, development, divestment strategies across the group and across all of the sectors that we operate in, so student accommodation, build-to-rent, co-living and affordable housing.
I'm George Dyer, so I run our divestment team at Watkin Jones, so that effectively is our capital markets, sort of investor-facing piece, so transact all our forward funds across build-to-rent, co-living and PBSA, and equally have the joys of a bit of asset management as well.
Obviously, you've got some very impressive projects that you've just been working on. So you just exchanged contracts with funds managed by KKR for the forward funding of student accommodation scheme in Bristol, and then, of course, your BTR development in Belfast with LNG. So we're going to dive in a bit more to that later on. It would be great to discuss with you both how you got into your personal experience and journey in real estate, and how you got into real estate to begin with, and how your career progressed to this point. So I don't know, Alex, if you want to kick that one off.
Sure. I guess I got into real estate by mistake, is the honest answer. I did psychology at university and really came out knowing one thing, which was I didn't want to be a psychologist, didn't want to be a psychiatrist, and realised I had to do something. So I ended up going travelling for a year and contemplating what I might do. And the one thing that had always interested me was the built environment, architecture, beautiful buildings. And yeah, so I guess with nothing better to do, I thought I'd move into that sector. So I did a master's at Oxford Brookes University, or Brookes College Oxford, as my grandfather insisted on calling it. And yeah, I probably did quite a classic route. I then graduated that and went to Savills and did their graduate recruitment scheme. Had a really good time there, really enjoyed it. They're a very good organisation. And then, yeah, I did the rotations. I did a mixture of commercial and residential, which I found really beneficial. But I always enjoyed the residential side more. I found it more interesting. I found the people more engaging. I found the real estate more identifiable with. And so I did 6 years in their capital markets team on the residential capital market side, mainly focusing on student accommodation, which back then that was the 2005, 2006. So the sector was really just starting, and it was quite exciting. No one at Savills really knew who we were, what we did, and we stayed under the radar until suddenly we had the GFC, and suddenly we were the only profitable department in Savills, and suddenly it became a bit more mass market. But after that, I'd always wanted to go client side. I always wanted to see what that was like, and I really enjoyed the brokerage side, but I wanted to be a decision maker actually with regards to the real estate, and actually making decisions and actually delivering and developing something. So Watkin Jones was an opportunity that came along, and yeah, it's been quite a journey. I've been there since 2010, so I've transcended when I joined, they were very much a Welsh family business, and it was run as such, and I say that absolutely with zero disrespect. It was we did some incredibly good things, and yeah, that journey has gone from Welsh local sort of contractor through to national developer, all the way through to floating the business in 2016 and becoming a fully fledged PLC. And yeah, it's been a really interesting journey.
Also, it's quite interesting, I suppose, when you say about your psychology background, because as we all know, that probably plays more of a role actually in transactions. And I assume that does actually really assist you when you're reading a situation, when you have to gauge how people are feeling. It probably does assist in a way.
Yeah, look, I mean, anyone in my team will tell you, my three things are emotional intelligence, resilience, and adaptability, and they're all intertwined. And
Yeah.
I do think it's the most important thing you have in real estate is relationships. And I know we're going to come on later to talk about technology in property, and it could well transform certain elements, but one bit will always remain there is that ability to impact a transaction or a deal through
Yeah.
your personality, through your relationships. And yeah, that's the bit I find most interesting.
It's so funny you say emotional intelligence, because often that's something that is completely disregarded in a lot of sectors, specifically the real estate sector, because often people say, oh, this person's really good at transactions, or this person's very siloed into analytics, but often they're not, employers aren't often seeing the benefit of that more involved emotional intelligence. It's really refreshing to hear you say that, because actually that's something that needs to permeate the industry in a lot more ways, certainly from a brokerage perspective, because we always feel that emotional intelligence is incredibly important when you're managing various different people, whether it's lawyers or purchasers or even vendors as well.
So I, at York University, studying history and politics, had a sideline DJ career, as we've discussed.
Love it.
So yeah, I did undergrad there for 3 years. Similar journey to Alex, really. I think left having done history and politics and decided I didn't want to be a history teacher or wasn't that passionate about getting into politics itself. So ended up getting onto a bank graduate scheme, into corporate banking with Bank of Scotland Corporate. I did a 2-year rotation. My first 6 months were in private equity based up in Leeds. Then went on a very interesting journey through 2007, 2008 with HBOS. Came down to London, did 6 months in what was the strategic finance group. Then I was meant to move to Paris to do leverage finance. And Lloyd's bought the bank and rightly said, we're not sending a graduate, all expenses paid, to Paris for 6 months. So they said, well, we've got a job in the real estate private equity team. Do you want to do that? I moved over there for 6 months, not really wanting to get into real estate, a bit like Alex, and ended up staying for a year within that team, working on really restructuring some of the very complex and challenging positions that HBOS had got itself into. And after the 12 months, managed to get an interview for an analyst role. So transitioned over to Schroders into the fund management side there, working on fund-to-fund investment across the UK, but then latterly more on the global side as well. I was there for about 2 years, became quickly apparent that the Eurozone bond crisis was really hampering equity raising. And that team was still operating a couple of funds, but there wasn't too much long-term growth. So I got a job at Invesco, working at in the UK Nordics transactions teams. That was predominantly doing deals in Sweden initially. So I was there for about a year and a half doing that, and then moved over to what was a global mandate for a German pension fund, investing opportunistically into anything that was real estate. It was really quite multifaceted and very interesting. And then I had met a good friend, Paddy Allen, out in Amsterdam. We were both working out there, and he'd moved over to work for Nick Porter. So he sent it was a platform called GSA. And he said, well, why don't you come in? And I ended up running 2 joint ventures there. So it's been a pretty big journey for all of us, and myself, Paddy, and another colleague, Andrew. And yeah, really switched from poacher to gamekeeper. Did the Vita deal with DWS, did some stuff in Ireland, some stuff in Spain, and then did a deal in Wembley, which is where I first got to know Alex properly. And yeah, we had a number of chats over a bit of time, and Alex said, we've got this really interesting role. And that was 3 years ago. Watkin Jones has been great. It's been a really, really interesting experience, seeing the business grow, built a really interesting team around it as well.
Brilliant.
Fascinating journey, isn't it?
Yeah.
Because often in real estate, there's a very predefined course, so to speak. You go to, akin to Alex's experience, you go to a graduate program, and then you go on rotation, and then afterwards you elevate yourself through that. But it's really interesting to hear that actually you went through a completely different route, and especially that private equity and finance route, because ultimately, and that's where parts of the real estate business are heading. But it's really interesting to hear from you how you see the differences in the sectors. And do you feel like the finance and private equity sector was a bit more fast paced, or that they were further progressed, or they had different tactics and methods for marketing themselves than the real estate sector has. It's just interesting to understand a bit more about the differences.
Yeah, from a PE perspective, again, wasn't a huge amount of time, but the whole vendor DD piece is very interesting. The fact that you can close a deal in 2 weeks, which,
Yeah.
well, we've just done, but it's that state of readiness, getting to market and getting things sold. And yeah, it is incredibly analytical, incredibly around focusing on the numbers and how that all works through. There's a lot of sort of themes you can take from it. That relationship is still very important. How you build that relationship across a deal. Real estate has a bit of a way to go in terms of probably moving that direction, but operational real estate is effectively buying companies in many ways or buying operational exposure. So people are more and more attuned to it with more and more private equity guys come into the space. The sector is having to evolve. The days of the sleepy fund manager doing a deal and taking 6 months to get it done is, with more and more private equity guys coming into the space, that will diminish a bit. You still that focus on transaction speed will increase. Equally, doing stuff in the US, we did a deal in Boston, closed that in 4 weeks, start to finish. But the vendor was absolutely shouting at us because 2 weeks is standard in the US.
Oh, seriously?
Yeah. The UK still got a bit of a way to go on that. But yeah, it's something we've been very focused on as a business. How do we improve that transaction time frame? It de-risks the transaction.
George is right. Speed of execution. If you look at what's happened in the economy, in the environment since 2016, we seem to have moved away from these very long bull markets where everything's smooth for a long time and then you have a long decline. It seems to be a lot shorter, sharper impacts. The world moves much quicker and everyone's trying to catch up to that. So you might only have a 6-month window before your next economic impact hits. And so we're trying to become a bit more attuned to that.
And how have you found, Alex, that the processes have changed, I guess, since you've gone from a private family-owned business to a public company? Have you found that, has it slowed down the process in some ways, or is there a lot more legislation and that type of thing, or are you finding that it's still the same speed that you can execute these transactions?
Yeah, no, we've got processes now. No, clearly there's huge differences and actually a lot of similarities. As a family business, I guess we prided ourselves on being able to be quite entrepreneurial, be quite fleet of foot. We put a lot of stall in. Our word is our bond. If you shake hands on a deal, you then go and execute the deal. Actually, all of that is still absolutely applicable to the way we try and do business now. We are massively partnership orientated. The 2 deals we've just done with KKR and Legal & General are absolute manifestations of that. Those have been driven by personalities and relationships which have gone through previous deals, history, track record, but also personal relationships. And so all of that you learn as a family business absolutely translates into a PLC. I think clearly you need to have more due diligence, you need to have more paperwork. I'd say the general core analysis remains the same. It's real estate. You've got to work out who's going to live there, who's going to buy it, what it's worth, what it's going to cost. All of that remains the same, but yeah, look, that it comes with the territory. If you're going to be a PLC, your shareholders want to understand that there is really good governance, really good due diligence. And I don't think it needs to slow things down too much. If you do it badly, it will do. But if you can get some good processes and good people, the key thing is you can have the best processes in the world. And if you don't have good people, it'll still be slow, it'll still be clunky. You can have the worst processes in the world. And if you've got good people, you can still make things work.
Yeah.
What we're trying to do is we've got really good people and we're trying to make our processes match that. And that's the whole how you improve as a business.
I mean, what's really interesting to hear from your perspective is obviously you joined and then 6 years later you IPO'd. And what do you feel like are the key decisions that were made along those 6 years to get from the family business fleet of foot to that IPO point where the business had grown quite significantly and there was key objectives that had met in order to really hit that larger scale national developer status?
It was a gradual transition, and it came out of a really tough time coming out of the GFC. We were probably over leveraged as a business back then. The banks asked for all their money back, and that forced us to really change our strategy and our outlook. And we moved from a more traditional developer model where we were building out stock using debt and our own capital and then trading it. And that, I guess, created, through necessity, a much more capital light model, which was the forward fund model. To make a forward fund model work, you really need to understand institutional capital. You need to work out what they need. You're asking someone to pay you £100 million for a piece of derelict land and 6 inches of documents and specification documents. To do that takes trust, it takes track record, it takes a lot of building up of those relationships. So our whole attitude started to change as we went into this capital light model. Reasons for floating were probably very similar to many family businesses. The family did want to take some chips off the table. This business has been running since 1791. It was 9 generations of family. And yeah, they did want to take something off the table, but they also wanted very much to stay involved. Being a PLC, we looked at it as a real alignment with our clients. What's going to work for the institutions? Well, if you've got that PLC status, they know that you've been through that due diligence. They know that you've got good governance. That helps the alignment. And we also realised that we needed to change our management structure. One of the classic characteristics of a family business is you have quite a narrow leadership structure. You do end up filtering everything through to the family for ultimate decisions on key things. And as you get bigger and as your projects get bigger and more complicated, you can start log jabbing the system if you don't have a more appropriate management structure. So the key things for us for floating were, one, the family obviously had their own drivers, but we wanted better alignment with our clients and the ability to grow. And we also wanted to sort of modernise the business and modernise the management structures. So those were the key things that were playing on our mind when we went through that process.
Brilliant. Okay, so we're going to jump into our 2 truths, 1 lie. This one is specifically about co-living. So I'll read out the 3 statements, and then afterwards we can just chat about which one we think is the lie. So the first one is the average age of a co-living resident is 25. Second statement is co-living is more affordable than BTR. And the third statement is there are only 3,500 operational co-living beds in the UK at the moment and a pipeline of 30,000.
Okay, so average age of 25 for a resident. I can believe that. Where the product's positioned, we've seen and we've got a couple of, I'd say, smaller schemes that are effectively co-living across the wider Watkin Jones business, but there's a real mix of ages from speaking to our operational colleagues. So I could see that trending down. So 25 would make sense. Ability is an interesting one because I suppose it's how you define ability in the context. If it's on a pure rent per square foot, probably co-living will be more expensive because it's more dense. But equally, in terms of services, amenity provision, all-inclusive rents, and that's typically what you get with build-to-rent. So stripping all that out, it's quite a subjective question, I suppose, on that one. And then the third one was,
about 3,500 operational beds. Okay.
Yeah, which again feels about right.
Sounds about right, doesn't it?
So I'd say the middle one is probably the lie of the 2 out of the 3.
It's an interesting one, isn't it? Because age of the co-living resident, everyone thinks it's quite young, don't they? And
that's quite like a misconception.
Yeah, and it very well could be 25 or could be 23 or 26. I don't currently know, but from our knowledge of speaking to quite a few people in the co-living market and certainly at Folk and various other locations, it seems like you go
30
anywhere
plus.
from your early 20s all the way up to, I think the oldest resident was like 83 or something, wasn't it?
And then what they've found at the moment is tracking more of like a 30 plus age demographic, which is actually super interesting when you think about people thinking that it's a graduation from student, when in fact actually it's appealing to an older demographic. Also, the fact that it appeals to a much wider demographic makes it such an interesting use class because, of course, you can have some students within the building, but it's not exclusively student. And then you can appeal out to a much wider demographic.
Yeah, no, you've hit the nail on the head. That's really the way we look at co-living. Why it's interesting is you can have lots of different narratives. It's not just the same narrative for each location and each scheme. I do think there is a place for co-living in UK real estate. There will be a few people who catch a cold on it because it doesn't work in all locations, in my opinion.
Yeah.
And it looks great on an appraisal because, as George said, it's a very dense product. Therefore, you can drive high pounds per square foot values. But you really need to do your research and understand what is your narrative? Who is your customer base? Who are you appealing to? Who is going to live there? Co-living has a bit more nuance.
So which one, Alex, do you feel like is the lie in this three?
Yeah, I'm probably pretty aligned with George. That 3,500 beds built. It might sound even a bit high, but it probably is in the realms of reasonableness. I'd say probably the age one is, it could be 25, it could be 30.
So it's the average age is the lie. So it is 30 plus
Wow,
average at the
interesting.
moment.
1-0, George.
But that's also an interesting one, just to progress that co-living conversation, because obviously you guys have, I would say, a lot of transactions that have happened within the co-living space have been largely London centric. Obviously you guys have identified Leeds as a key location, and I would love to hear more about that strategy. And also with your, obviously, BTR and Belfast, you are not afraid of being the first movers in a new location. And I would love to hear your thought process behind that and the strategy behind that.
Sure. I mean, look, if I pick up why Belfast, and it's quite a good analogy for Watkin Jones' approach to real estate. We got into build to rent off the back of PBSA. We looked at the synergies. We looked at what are we effectively doing with PBSA. We're creating communities for people to live in within a building, and that's the exact same thesis for build to rent. So we were one of the first developers, well, the first private developers to go across to Belfast, and we looked at the demographics for students. There was 2 great universities. There was almost no accommodation other than university provided accommodation. And the question was, well, why should this city behave any differently to all the other UK cities? There's going to be the same demand drivers. People are going to want to have better quality accommodation. So we took that big leap, and it was a leap of faith to an extent, but it was an educated one. We did the first couple of PBSA schemes in Belfast, and we've ended up doing 5 or 6 there. And we were able to take that, I guess, that confidence and knowledge that the city was behaving how we thought it was, and translate that to build to rent. When we were looking at that overall thesis, again, it was the same thing. Is Belfast is one of the most exciting cities to visit. It's got fantastic leisure, fantastic restaurants. It's hugely popular now with office occupiers. All the big corporates have got big offices out there. All of this is creating this environment, but there's no residential within the city centre. So, to us, build to rent was a no-brainer, albeit it had never been done before.
So is that gut feel then, or is it a combination of data, gut feel, and everything in between? And obviously that goes into a conversation about AI, which we'll talk about later, but you've got the analytics, you've got the data, but ultimately you've got to make a decision based on what everyone feels is the right outcome.
Yeah, for me, and the way we are quite rigorous in our approach on this. Every year we will do a target market analysis, and it's quite a detailed quantitative analysis where we feed in lots of data into a model that we've built, and this is for co-living, student and build to rent, and it spits out cities that we should be looking at and targeting. That quantitative data is really important, and you need to be fact-based, you need to be data-driven. But in real estate in particular, there is always a qualitative element. There is always a human factor, and more so in residential, because everyone can identify with residential. Everyone's got an opinion on what a residential building should be or should provide. So we would be pretty foolish to just rely on the quantitative data if a fund manager is telling us we are never going to invest in this city for completely different reasons. So we do a quantitative analysis, and then we put a qualitative overlay on it to say, look, what's happening on the planning environment, what's happening in the political environment, what's the investment appetite like. If you match both the quantitative and the qualitative, and both are positive, that's when you invest.
And George, I'd love to ask you, how do you keep innovating, and what are your key milestones for innovation at Watkin Jones?
There's probably a number of elements to it. Firstly, on the analysis, how we're looking at markets. As Alex says, we really progress that. Keep how we're underwriting, how we're looking at rental growth, how we're looking at yield profiles, how we're looking at the underlying the investment thesis is quite important. And then equally, how we're looking at our internal processes. So how quickly can we get stuff to market? How can we be as efficient as possible through our legal process? How can we alleviate that initial 20% of getting the contracts ready to go and things like that? All these incremental elements have such big benefit at the end if you can get it right. And then the product itself, we constantly reviewing our specs. So that happens once a year. We're about to relaunch our PBSA spec shortly. Looking at the trends in the market, ESG, what do we need to be doing there? Not just for now, but also for the next sort of 3 or 4 years, because that's how our investors are looking at the developments themselves and beyond.
One of the key questions that I often get asked is forward funding a structure that we want to do? Has the forward funding market come back? And is the structure still appealing? And I suppose it would be great to get your views on that, because clearly the structure has gone through lots of different iterations over the past few years, and we've seen rise in debt costs and various other things. But from the transactions that Jen has talked about, we've seen that actually that is a structure that is sustainable.
I still think forward fund is absolutely a viable transaction structure, and it'll be the predominant structure going forward as well for a number of reasons. There's no point pretending that forward fund is rocket science. It is a relatively simple concept and structure, but it's actually quite hard to do well, and it's very hard to do at scale. And again, it comes back to a lot to do with trust and track record and that counterparty position, because you are asking some risk-averse capital to give you their money to deliver them something. They can't see it, they can't touch it, it's not there at this point in time. So yeah, you have to be able to demonstrate that you're going to look after their capital and you are going to deliver, and putting all the various checks in place to give them that confidence is more difficult to do over a sustained period of time. If you look back and say, what am I really proud of at Watkin Jones, it's that we've done multiple transactions with the same parties. Our repeat business with institutions is phenomenal, and that is not because we get everything right on every single transaction, but it's because we make sure we sort it out. If something has gone wrong, you problem solve, and you make sure you honour the relationship, and that's why they will come back, because everyone recognises building a large-scale development has its challenges. Things are going to go wrong. Unexpected things are going to happen. So look, forward fund absolutely is a great capital light structure. The investment market like it because it allows them to stay right on top of the current trends. You are getting the newest stock in the market, so you are getting the most future-proof stock in the market. You're getting access to that. Also, there's much more capital looking to allocate into the sector than there is stock available. So the only real way to access it is through forward funds.
What's good about the forward fund structure is a very delineation of risk between the development side and then the market risk. And it is the simplest way of approaching it. Ultimately, boil down investment to its simplest form. It's basically buying and selling risk. And we buy a plot of land, we get planning on it, we take the risk on for that, we then build the scheme. So we take all that risk piece through. For a funder, they are sat there taking the market risk at the end, and having that clear delineation works for everyone. Now, obviously, at times like this, there becomes a more general question of, is that risk return metric right? And then that may lead to some flexibility on structures in the short term. But if you look at where the funds are in general and where people want, how they want to invest into the sectors and what they want to achieve in terms of returns and risk, the forward fund is the best way of getting that balance. Slightly dislocated markets at the moment, as we all know. But the reality is that trend will come back. I can't really see many funds stepping into that development piece.
Yeah.
And even if they are pushing that market risk back onto the developer, which I know some are, and a variety of different structures, all that's going to end up happening, and in the worst case, is effectively you've got a very, very unmotivated developer who's out there, and ultimately you in the end you are taking that. You think you've offset the market risk, but actually taking on the development risk because that developer has not got the alignment that you need to deliver that product.
That's absolutely right. And what Alex said about delivering the best and brightest in locations is really apt, because ultimately what we're all seeing in the sector, and certainly the operational real estate market across all living elements, is that trends are evolving so quickly, whether it's fire regulations or ESG strategies or technology or various other things. So actually having that new product is becoming more and more desirable, because when you are buying existing portfolios, certainly ones that are built 10 plus years ago, there are issues clearly across a broad variety of different categories, and also the ability for students to live in those buildings, or obviously other residents for BTR or co-living. That's a really fascinating point.
Yeah, and also I'd love to jump back to that innovation point, because having your own operator in Fresh, obviously incredibly innovative and really gives you that competitive advantage. I'd love to know the thought process behind that and integrating that within the business and the key benefits that you've seen from that in terms of adaptability and strategy.
Fresh was launched the same year I joined the business in 2010, and it came from a place where actually the woman who we brought in to run it was a lady called Rebecca Hopewell, and she'd been a fund manager at Quintain, and we were doing multiple deals with them at the time. And the honest answer is she was a continual thorn on our side, looking to make us improve our product, making us. She wanted the best experience for her customers, her students, and she wanted the best buildings, and she kept pushing us to improve. And actually, we responded, and then that's why we had a good relationship, and we did sort of think, actually, we should just have her on our side, and actually, rather than having an abrasive relationship with an investor, let's get ahead of the game. Let's start thinking about it from that point of view, and not from a contractor developer point of view.
Yeah.
Let's think of it from an end user point of view. And it was really a very forward thinking piece of work from Mark Watkin Jones, who launched it, to say, actually, how are we going to get more? It was driven, how are we going to sell our portfolio? How are we going to attract institutional investment into the student space? Because at that time, UK institutions weren't investing in the student. It was much more private equity and private companies. And what we realised was they don't want to manage this stuff. They don't want to be associated with day-to-day management and the headaches that people commonly perceive with students. So we built this Fresh platform, firstly, to support our own sales and to be a conduit for institutional investment. Little did we know how successful they would be and how much of a demand there would be. And yeah, we try and lever that. For us, it's not just an income stream driven by Fresh's management fees. It's much more holistic than that. It is all about what value add do they have in our product development? What value add do they have in the markets we should be investing? What intel can they give us on trends that they are seeing? So it became a real no-brainer. So they were set up originally outside of the Watkin Jones business as a standalone, but when we floated, we thought it'd be disingenuous to our investors and the business if we didn't buy them in pre-float. So Fresh became fully integrated within Watkin Jones just before we floated, and yeah, it now gives us that end-to-end solution.
I suppose as you identify that whole piece about the benefit of having these operational buildings is that tenants become customers and they're getting that elevated experience versus being in a typical HMO whereby you've got grumpy landlord and your tap's broken and it takes a week to fix and things like that. So looking at it from the end user has really revolutionized and will continue to revolutionize how people live and how people demand to live. At the moment, it's there and people are buying into the product. In the future, it will be non-negotiable that they're in these built environments where people actually care about their user experience.
Obvious question in the market at the moment from an investor's perspective and post-Ukraine and everything else was always what's going to happen with the OPEX. And we obviously saw a really sharp rise in OPEX and now slightly plateauing off. What are you guys seeing from your experience of working alongside Fresh?
Yeah, look, OPEX clearly did increase, and that was largely driven by fuel and energy costs. That was one of the primary drivers for it. As a group, we try and be on the front foot. You can't outrun it completely, but we did hedge from a Fresh perspective. They hedged all their energy costs, which meant that their clients were insulated to a much greater extent than perhaps others were when that real peak came on. We'd bought in energy costs much earlier, so that was a real advantage. I do think, particularly on build to rent, actually, there's still a way to go. Operational costs will come down because increasingly people are learning the lessons from PBSA about how to manage mass occupied buildings. On the build to rent side, it's still a little bit dislocated. It's still a bit regionalised. It's moving from that more traditional way of letting residential buildings into a much more commoditized way of managing. So I do think there's scope to drive down the costs, and it's something that we're looking at continually. Technology, will play a part in that. Lots of people moving to those app-based systems so they can try and deal with tenants' queries, the leaking sink, etc. So there is still quite a way to go. That technology will help drive down that or drive that operational efficiency.
So we're going to get on to future of property and discuss about how technology can drive the industry forward. I'm going to kickstart that with our 2 truths, 1 lie. So the first one is ChatGPT is the second fastest app of all time. And second statement is Goldman Sachs predicts 300 million jobs will be lost or degraded by artificial intelligence. And the third statement is AI can learn tenant behavior patterns to optimize energy consumption. What do we think? Which one do we think is the lie?
Interesting one. Second fastest app.
I can well believe that. It is creating a massive storm.
Yeah.
You cannot avoid hearing about it, talking about it. We were at an event last night where they had effectively a futurologist talking purely about that and AI and its impact. So I could well imagine that has been one of the fastest growing apps. It's quite terrifying, actually.
The 300 million jobs lost. I mean, again, I could quite believe that in the context of what, the potential for it, particularly, in some industries. There's going to be a real shift away from that sort of process piece. Now, whether I don't believe those jobs will necessarily be lost, but there'll be a shift in working patterns and approach, which could have massive benefits for society. We might all get a little bit less, which would be good. But equally, I don't think that's a crazy statement. And then the final was on energy costs, and I absolutely could see that. Yeah, and I've heard of a couple of developers doing stuff, particularly in Europe, around energy consumption and able to use data to assess how a building's going to heat up during the day based on weather forecasts, and then adjust the blinds and things like that to lower that. So it's a really interesting approach, and as we all move towards that net zero target, that's very become much more prevalent around building operations and probably maintenance, predicting when things might break and when you might need to replace a part and things like that, rather than getting ahead of the curve, rather than waiting for that sink to leak. You're actually that on balance, that's probably going to break in X months. I don't know.
Quite interesting, isn't it? 'Cause 300 million jobs is quite significant, to say the least, and certainly something we've never seen, even in the global financial crisis, or anywhere close to that number. So it's quite a large number. You just wonder whether that's accurate or over-exaggerated, or actually it's just going to completely redefine how we all live and operate. I mean, we were reading an article the other day about AI and how actually, because of artificial intelligence and ability to do all of the analytical side of the workplace, that actually clearly, Alex, what you said earlier, that relationships are becoming increasingly important. And clearly real estate's always been a relationship business, but that it will actually cause people to possibly be in the office more, and that work from home might eventually start to reduce over time, because if you've got AI and people have got the ability to essentially get those services without a human person doing it, then it's all about the relationships, and then one has to be in the office in order to foster those relationships. So it's just an interesting counterbalance between the trends that we're clearly seeing of working from home and having more of a flexible lifestyle.
You hear so many different theories about whether people are going to go back to the office or stay away from it. The futurologist yesterday was predicting actually the reverse. He felt that actually, and again, it was quite interesting. He was talking about the new Apple goggles and just how groundbreaking they were in the ability to sit there and still be in a room and seeing things as you normally would, but you've got your apps, you've got your screens in front of you. You don't need an office. And he was saying you might not need to equip. Everyone's got on the trend of building build-to-rent schemes with home offices, because that was the thought that everyone's going to need a home office space because they're not going to travel to work anymore. But he was saying you might not even need that now, because all you need is a sofa and these goggles, and you've got your 4 screens up in front of you. You've got all of your apps. You can do your Teams call. You can see someone right next to you, even if they're sat across in a different country.
Incredible.
That is incredible, isn't it?
Yeah. I mean, I suppose Alex comes back to what you were saying before about the success or people that have been particularly successful in the real estate sector, having that emotional intelligence really as a factor is like the irreplaceable part. And those emotional intelligence, relation-based roles, industries perhaps won't suffer so much in the rise of artificial intelligence, but depending on how far it can go. But definitely, like Jamie was saying, I guess more those input and output roles that can be replaced and don't need that added input or relationship input or emotional input. Definitely, I can see that being under jeopardy.
Albeit that, I guess to play devil's advocate on it, there are those AI-generated chat rooms now where you can find an AI-generated friend who's there to listen to cues and
It's crazy.
and actually respond to your emotional needs, and so possibly even that emotional intelligence bit could be replaced by AI, which is a terrifying thought.
Yeah, I mean, you hear. I don't know if you saw that film probably about 10 years ago.
Oh yeah, the Johnny Depp one.
I can't
Is it
remember
Johnny Depp?
who actually was in it, but
And
there
he
was
falls in love with the AI.
yeah, falls in love with an artificial person at some point in the future. And it feels like actually that's something that might actually be real at some point.
Or it's like
in
a
the future.
Blade Runner-esque.
Yeah.
Yeah.
But it's interesting what you were saying. We were having a conversation yesterday about data and how, like, as you say, AI will be able to do all your data analysis. And so the question got asked, well, AI is effectively sourcing that data just by sifting the internet. So how hard would it be to manipulate that? And you get your AI bot to put a lot of false data into the market to drive up a market or drive a rental profile.
True.
So could you then find yourselves actually having to monitor, having the human aspect, monitor one AI bot versus another AI bot?
Yeah, makes sense.
To actually discern what is the truth and what's not.
It's true, like fake news, I suppose, and things like that could be a lot more damaging and travel a lot quicker if it's coming through on these platforms where you're taking what's coming out as fact. And in fact, do we need to like challenge? We think AI is that's fact and truth, but you're right in saying, well, how do we know in the wrong hands what's actually being fed to us and who's actually managing these platforms and what are their goals behind putting this out there?
So going back to the two truths and a lie, which one do we think is the lie in this instance, Alex?
I'm going to go 300 million jobs.
With ChatGPT being the second app is probably might be number one. I know.
Yeah, I agree with you, George. That's probably right.
Well, George, you have redeemed yourself on this one.
Score draw.
Nailed it. It is the fastest growing app at the moment, which is interesting, terrifying, interesting.
It's pretty scary. And we had at dinner last night. One of the people saying that they've had some of their team using ChatGPT to take meeting minutes, but then someone made a joke and it's like brackets, a joke at someone's expense within the minutes, all this stuff. So.
Oh God.
Yeah, I joined a meeting the other day where there was an AI actually present on the meeting on Zoom, and it was making notes of the meeting, and then it sent follow-ups based on what you said during the course of the meeting. Oh, I'll send this document, or I'll provide you with this comparable evidence and various other things. So you got various emails afterwards from this AI asking for the information. It was quite interesting.
It's so interesting.
Yeah, so it's already happening. But moving on to how it's actually going to affect the student or the person living within a co-living building or living within a BTR block, what do you see in terms of your developments? Because clearly these are developments that have been tried and tested over a long period of time and iterated and innovated. But how do you think that innovation is going to really transform the built environment and specifically focusing on living?
From a technology perspective, or just general?
From a design perspective as well, and how we look about interacting with physical real estate.
On that basis, student accommodation built to rent has evolved. If you look at the core product, it hasn't changed a huge amount. You still have pretty much rectangular boxes with bedrooms and living areas, etc. That hasn't changed that much. But what people have done a huge amount of work on is actually what is the customer journey? How do you create these meet points? How do you create an opportunity for someone to meet someone, interact, and forge the community? It's all driven by that classic. If you have friends in the building, you are more likely to stay. All people operating residential real estate want people to stay. You don't want to have churn. You want longer tenancy terms, etc. So we put a lot of effort alongside Fresh in terms of trying to map out how do you facilitate that within a building. And I have seen some developers, I didn't necessarily agree with the strategy, but they had a lift which enforced you to get out at certain floors, even though it wasn't your floor, because what they were trying to do was actually manufacture meeting points and getting what could be quite an anonymous building. You've got people probably complaining that they've been kicked out of the lift on that floor. I'm not sure we would go there, but there is that concept. And on single family housing and build to rent, people are trying to understand actually it's easier to create a community potentially in a building where you've got a captive audience and you've got set meeting areas. How do you do that on an acreage where you've got individual houses? How do you foster community within that environment? So that's quite interesting. People haven't quite landed on it yet, but again, people are looking at how they orientate roads, how they orientate the footpaths to try and make people meet. That is a really interesting concept for residential for rent.
No, that's a great point, and certainly something that everyone needs to consider more and more as we move forward, because as you say, technology has the power to actually bring people together in so many different ways. And actually, if you're living in a build to rent block or single family housing and you're uploading your profile, I suppose, to a portal beforehand, and then it's matching like-minded individuals together and somewhat manufacturing those in some form of way, that then creates that sense of community that feels a bit more natural than just a forced encounter.
Yeah, no, definitely. I can definitely see a world where they've got like Tom drinks 3 glasses of wine a night. Tom must go to the cocktail making class tonight.
Or there's a DJ night.
Yeah. Headed up by yours truly.
I don't think people would be learning much if that was the case.
You'd be flocking down from York
Yeah.
You are going to have to come out
I'll
to the
certainly
time.
go.
for one last
definitely go.
hurrah.
I really shouldn't have shared this with you at any point.
It's going to run and run.
One more question from my perspective, if that's okay. Obviously, you've both come from, at some point, an agency. So obviously, Alex has come from an agency through the grad program. You've come through a different method, which is coming from a more client-side business into the agency world, and now moving both into development and management roles. So what do you typically look at when you are looking to appoint an agency coming from that type of marketplace? It's just useful to understand the key things or tick boxes or elements of that make your decision a bit more nuanced.
Yeah, like for me, you need to see some evolution and you need to see some entrepreneurism from your agency advisors. The days are sadly gone where you just put out a brochure and you get 10 bids and then you go for best bids and everyone's a genius. People need to work harder in these environments, but also just going forward. So what we're looking for is good alignment with our advisors. We want them to really understand us, our business, what are our drivers. We want them to obviously connect us to the best capital and be innovative in how we might approach it. And sometimes you need your advisors to challenge you. They're not just there to agree with you, they're there to challenge you and push you. So yeah, a combination of all of those really. George is probably closer to it than I am these days.
For me, it's analysis plus narrative, where people have had a load of bids, as Alex says, 10 bids on assets, and here's a PDF brochure, fire around the market. Bids in 4 weeks, guys, off we go. That is definitely oversimplifying it, but there is a degree of truth that really honing on that narrative, why to do a scheme, why to invest in Belfast, for example. That takes quite a key skill. That hook is really important to getting the fund manager or the acquisition guy really hooked into a scheme, and then it's really the analysis that then backs it up. And then for me, it's that project management piece as well. It's like you need the best agents and ones that drive the deal forward as well. Now, we're pretty bad at letting agents drive the deal forward because we just, the way we're set up, we will drive it ourselves. But equally, for transactions to happen, particularly in this market where it is more volatile and where things can move week by week, having that agent driving the deal, making sure that the other side is performing to timetable is really, really important. So those are the key bits. And the other bit is just around structure. As you alluded to earlier, that obviously the forward fund that we all believe will be there long term, but there is more and more nuances around that in the short term, given the volatility. So really understanding that and how that works for capital, how that works for the developer, where that risk sits is really important. So that's the other element, which, when you've had a very, very clear run of forward fund after forward fund, and it's been very, very clean and lots of bids, introducing that complexity creates, it requires a bit more entrepreneurial spirit and also a bit more analysis to really understand this is what you're going to receive and this is what the returns will be.
Yeah, and you're both quite right. I mean, how we feel is that with the PDFs and the brochures that have been put out, it's worked in those bull markets, but actually now people are much more critical and they want to really understand and get under the skin of, well, what am I actually buying here? And especially from an operational real estate perspective. And as we continue to see structural changes in offices and new capital pouring in from all parts of the market, the collaterals that as agents we put out need to be educational, not only on the product and where it is, but also on the broader market. Because a lot of the time, as you've seen, capital is investing for the first time ever in student housing or BTR or co-living. So there has to be that sense of education on the use class and education on why the product is different, why the developer is different, and ultimately why that location is particularly interesting and fascinating for both tenants and investors.
Yeah, and that storytelling piece as well around the end user, like you guys identify so well, is that how are people actually going to operate, live, work in these environments? And sharing that with the investor is super important in order to create the full picture for them. So thank you guys so much for joining us today. Really, really interesting to hear what you guys have been up to, how you see the market, and more importantly, obviously, the future. And it was great to hear your perspective on where you think the built environment is going, your strategy and innovation. And just want to hand over to you guys if you have any final remarks or things that you want to share to anyone listening about your personal journey in the space or more broadly market related or Watkin Jones related.
Thank you very much for having us. I'll just reiterate what we said before. We are absolutely confident on the enduring success of residential for rent in the UK. We think from a student, from a build to rent perspective, there's still a lot of growth, there's still a lot of opportunity, and we will come through the various challenges that have been presented, and we've got a lot of optimism for the future of the sectors.
The overriding piece here is strategically and from a macro perspective, residential for rent remains really, really of key importance for all investors, and I think that will continue to remain. It's just, we'll navigate some turbulence in the short term, but doing deals with good counterparties, creating good products, more importantly, product that works for the customers is the key bit. However we look at technology, and however we look at AI, that will still be the driving forces.
Perfect.
Thank you so much.
Thanks, guys.
Thank you.
Thank you.